Hello. In my first ever YouTube video, we're going to discuss loan estimates. Yes, loan estimates. I know it's super exciting, but I will tell you the loan estimate is the most important document you will ever get in your loan package. So if you're thinking about buying a home, if you're thinking about refinancing, you truly need to understand what your loan estimate is and what to look for in the loan estimate. Your loan estimate talks about your monthly payment and the components of that monthly payment. Your loan estimate talks about your total cash to close and what all of those closing costs are. It talks about your interest rate and if in fact you're being charged discount points, your origination fee, title fees, etc. So it's a critical document and really important for you to understand that document. Now, I've owned a mortgage company for 23 years, and I will tell you there is way more to selecting the right lender than just choosing somebody with the lowest payment or the lowest total closing costs. And as a matter of fact, a lot of times those two items are mutually exclusive. So the lender that has the lowest monthly payment may in fact have the highest costs, and the one with the lowest cost may have the highest payment. So you really need to dig in and understand it. Plus your lender needs to advocate for you. They need to explain exactly what you need to get approved. They need to advocate for you as part of the home buying process. It's extremely competitive right now. So your lender needs to, let the agent know that you're good to go, that you're qualified, that they've looked at your credit, your income, your assets. And that realtor also needs to trust the lender. Are they local? Can they get the job done, etc. But that said, today is all about loan estimates, how to review them, how to understand them. So with that, we're going to go to an actual loan estimate, and I'm going to explain it. So for this one, we have our good client and friend, Bob Frapples. Thank you, Bart Simpson, for that one. Bob lives at 1060 West Addison. For you Cubs fans out there, you know what that address is. And as you can see here, he's buying a place that's $390,000. When you look at this loan estimate right out of the gate, the first thing you see is that the rate is not locked. So whatever's on here doesn't really matter because the lender can change this rate on you at any time. So make sure you understand it. Is your rate locked? Is it not locked? Discuss that with your lender. What is the interest rate here? So this interest rate says 6.375%. That's a pretty dang good interest rate in this environment. Plus, you would think this property is going to be a condominium. Now, condominiums, if you're putting down less than 25%, have an actual hit to the interest rate because it's a condo. Condos are viewed slightly more risky by Fannie Mae and Freddie Mac, and some of that is passed along to the borrower. So this rate would tell me, this is a pretty dang good rate. Maybe you should look into that in a minute. The principal and interest here, now that's just a portion of your total mortgage payment or your total housing payment. It's a big portion. It's $21.89 total principal and interest. Now in this scenario, Bob is only putting down 10%, but he has great credit. So his mortgage insurance, or PMI, is $67. What is mortgage insurance? Mortgage insurance protects the lender, not the home buyer, okay? So if you're putting down less than 20%, lenders are required to obtain PMI, private mortgage insurance, according to Fannie Mae and Freddie Mac guidelines. If you, as a client, as a borrower, default on that and you don't make your payments and the losses build up, mortgage insurance helps to protect the lender against some of those losses. So while people look at it as a bad thing, it's not necessarily a bad thing because otherwise you probably wouldn't be able to get a loan at less than 20% down, or if you did, the rate would be substantially higher. What goes into your escrow account? Now in this situation, it's going to be, if this is in fact a condo, it's going to be taxes. So 1/12 of your tax bill goes into your mortgage payment each and every month. And then your lender in the state of Illinois pays your property tax bill twice per year. In Cook County, that's typically March and August. In other counties, the collar counties, you're typically looking at June and September. But you pay one payment and then the lender pays those taxes on your behalf. Also included in here is an amount for homeowners insurance. So that is on a condominium, if in fact this was a condominium, that's called an HO6 policy. It protects not just your contents, but it protects the real estate within the unit itself. So your cabinets, your appliances, your floors, your wall finishings, etc. That's considered real estate and that's protected in your HO6 policy, okay? So again, included in this total payment here of $29.65 is your principal and interest, your mortgage insurance, your homeowner's insurance, that HO6 that we just talked about, and your real estate taxes. Okay, so all in, less than $3,000. After your property reaches 78% loan to value, your PMI automatically cancels, and that would drop your payment to $2,900. What's not included in here is an homeowners association due. So again, assuming this is a condo, and you can see here that this number is $1,641, it appears that there's roughly $800 in HOA dues. So when you buy a condo, obviously, typically the bigger the condominium and the more the amenities, the bigger your HOA dues will be. And that's critical because an $800 HOA due, HOA cost, HOA dues is probably the equivalent of $125,000 in sales price if you're comparing it to a single family detached. So really pay attention to those HOA dues. Now, what are your closing costs? Well, in this scenario, your closing costs seem huge. They're $20,801. We're going to break those down for you individually, and your total cash to close in this scenario is just under $55,000. So to buy this place with 10% down, you're going to need $55,000, okay? Let's get into what those closing costs are. As a lender, we have been given the dirty job of disclosing everybody's closing costs to you. So we may only charge an origination fee. Some lenders charge discount points to give a lower interest rate. Then you have to disclose your appraisal, your credit report, your title costs, the City of Chicago transfer tax, if in fact it's in Chicago. So we have to disclose everyone's cost to you, the buyer and the borrower. But let's get into those costs on the next page here. Okay, so here's your first warning sign on this loan scenario. The rate, as we discussed, was 6.375 on what we think is a condo with 10% down. That seems artificially low in the marketplace. There are some first-time buyer programs that actually allow you to get rates that are that low, even for a condominium. Typically, they have income limits associated with this. This example is somebody that doesn't necessarily meet those income limits. So what are we seeing here? Well, right out of the gate, you see 2.136 in points. So that's almost $7,500. We would never recommend that, especially to a first-time buyer, because you're paying all that money up front. Well, what happens if rates drop? Well, you could have refinanced, got that lower rate, and never wasted $7,500 to do that. So we would suggest you, as the consumer, look at another option. What interest rate is available with no points, or perhaps with just a half a discount point or 3/4? You want to compare your options to a 0 point, maybe a 1 point, but we would not recommend something over 2 points. Okay, then our origination fee in this scenario is $1,595. Every lender charges an origination fee. In essence, it pays for underwriting, processing, compliance, and investor fees associated with their loan. Okay, now you look into services that you can shop for, although most people typically rely on the lender to select these. In this scenario, the appraisal fee is $495, credit report fee is $231. Yes, credit reports have gotten crazy expensive. And as just a sidebar, credit reports are very expensive because FICO has jacked their fees up. That's one of them. But the other thing is, this is not just a singular credit report. When you buy a home, you have to look, we as a lender have to look at your credit at least one more time prior to closing, if not 2 more times, and sometimes it's just consistently monitored. Don't go out and buy a new car, a new Mercedes-Benz, a new BMW, or even finance a ton of furniture. If your debt to income ratios are a little close and you finance $10,000 or $15,000 in a furniture purchase, it could screw up your closing. So on that note, credit reports are a little bit more expensive because lenders are sort of watching you. Wait until you close on your home, get the keys, move in, and everything is funded before you start financing stuff. Okay, now you're into title fees. To close your transaction, the title company is going to charge you a closing fee. That's to act as your agent. So, to disperse funds on your behalf, to meet with the attorney, to meet with you guys, to coordinate all of the lender's documents, etc. They charge a closing fee for that. Then, of course, they also charge title insurance. This is a lender's title insurance policy. What does it do for the lender? It shows us that there are no unpaid tax liens on the property, that there are not previously paid off mortgages that have since been released, and a whole host of other things like the legal description and the actual tax amount of the property. So really pay attention to your title commitment when you get it in, and make sure your attorney, of course, looks at it. It's one of the basic parts of their job, so they need to know to do that. But make sure you pick a good attorney that's very well versed in real estate. So here are your closing costs. These are your singular transaction costs for $13,859 in this scenario. Now, if you find a loan that doesn't have any discount points, you're going to remove $7,500 from that number right there and leave you with a little over $6,000 in one-time closing costs. Now we look at your prepaid items, or I should say other costs. These are not technically transaction costs or loan costs or costs associated with borrowing money, but they may be costs associated with purchasing the property. So to record your mortgage and your deed in Cook County, in this example, would be roughly $224. And in the city of Chicago, they charge you a transfer tax. That transfer tax is $7.50 per thousand. Thank you to the city of Chicago. And in this scenario, it's $2,900 in transfer tax. You can't really get around it. Everybody has to pay it. And again, it's $7.50 per thousand. Now we look at your prepaid items. Your homeowner's insurance, again, in a condo, this is called an HO6 policy, is going to be roughly $480 on this. You would want to engage with a typical agent, somebody like State Farm, Progressive, Allstate, Farmers, etc. And then prepaid interest, what is this? Well, this scenario assumes you're closing, I think in this case we said April 22nd. So if you close April 22nd, you have to pay 9 days of interest at the time of closing. That's the interest from the date you close until the end of April. That means you don't have a mortgage payment until June 1, because otherwise you would have paid that interest on May 1. So you feel like you get a little bit of a break on your first housing payment when you in fact purchase your home, but in essence, you're just paying that interest upfront at the time of closing. Now your escrow, what's your escrow? Your escrow account is what we talked about earlier, where you have one full housing payment, and in that housing payment, you collect taxes and insurance. That goes into what's called your escrow account. Think of your escrow account as sort of a checking account that is tied to your mortgage. And the only dollars that can leave that checking account are for your expenses, and those two expenses are to pay your insurance and to pay your taxes. But in this scenario, you're putting 2 months, you got to pay for your policy 1 year up front, then you put 2 months of insurance into escrow for that cushion, and in this scenario, 4 months of property taxes in, okay? So really, this is what makes your total closing cost $20,801, as we've already talked about, $7,500 here, which could be eliminated through a higher interest rate, and really drop those closing costs. Now, there's another large credit that you get from the seller, which we're going to talk about here. But in this scenario, you have $20,000, $20,801 in total closing costs. Your down payment of 10% is $39,000, as the sales price is $390. And then this adjustment or other credit here for $5,000. This is what's called a seller tax credit. So in the state of Illinois and in many states, real estate taxes are paid in arrears. So, you know, the 2024 tax bill in Illinois is just being paid now. So the first installment, the first 6 months of last year was just paid in March of this year, and the next 6 months will be paid in August of this year. So the seller owes you money for taxes on this property since they lived in it, but yet those tax bills aren't out yet. So they're not yet due and payable. So they give you a credit for the amount of months they owe, and your attorney can help you with this, and your lender can help you with, and your realtor can help you with this to calculate what that seller paid tax credit is. And that lowers your closing costs, or your, I should say, your cash out of pocket to under $55,000. So again, if you look at an interest rate that's a little higher, which might make sense, you would eliminate a lot of those discount points, and you could get this cash to close under $50,000. So, you know, there's a lot of stuff on this last page that talks about, you know, your APR. I've been in this business for over 30 years. APR is still confusing to me. The idea is it's all of your closing costs expressed as a cost of credit over the life of your loan, but it's a confusing number to look at. By all means, pay attention to this page, but really look at this page. Look at your top section, your interest rate. Look at your total payment here. Look at your total closing cost, your cash to close, and then understand what those costs are individually. So I hope you got something out of this video today. We truly believe in educating borrowers. We love helping first-time buyers and borrowers and teaching them the ins and outs of the mortgage process. There's a ton to it, but the loan estimate, again, is the most important document that we send to you, and it's critical to make sure you understand it. Thank you for spending some time with me today.